Good morning, ladies and gentlemen. Welcome to our podcast Perspectives in October. Guy Wagner, good morning.
Good morning.
Since our last interview in July, there hasn't been much change in the economic situation, and the approach of winter is creating a lot of uncertainty on the energy front. Economies are clearly slowing down. Are we heading for a global recession scenario, Guy?
I think what's clear is that the economy continues to weaken. People are always obsessed with this recession word. But clearly, what one can say is that a lot of factors are going in the wrong direction. We see increase in the energy prices. We see increase in inflation. Clearly, you have a lot of things weighing on the economy, and I think a lot of signs point towards quite a sharp slowdown in economic growth. Yes.
One of the key factors for sure is inflation. On this front, things aren't getting any better. Is there, in your point of view, any chance of an improvement?
Yeah, I think the official numbers, at least starting in the US, will continue to come down. We had inflation a little bit above 9% a few months ago. Now it's, I think, something like 8.1. So the official numbers should continue to improve, at least in the US, given that you have the base effect. So inflation is always compared to the same months from the preceding year, so that base effect is starting to play a bigger role. And then you have the decrease in commodity prices, etc. So official numbers should continue to go down, but the problem is more with what markets are calling core inflation, so inflation X oil price and food prices, and there inflation seems to be much more sticky, and there even core inflation has been going up in the US, and that's, I think, the main problem when it comes to inflation and also to the reaction of the monetary authorities.
Mm. Some experts think that the current surge in prices will logically start to recede while 2023 following the significant slowdown in monetary growth in 2022. Do you agree with this view?
Yeah, I think, I think that inflation, again, the official numbers, and mainly in the US, but the US, what the US economy does, what the Federal Reserve in the US does, what the US markets are doing is basically the most important thing when you look at financial markets. And in the US, the official inflation numbers should indeed improve. But again, the problem is more behind these official numbers. You have the core inflation, and there, at least until now, you don't see any decrease right now.
The US Federal Reserve and the European Central Bank are playing the monetary tightening card with high interest rate right now.
Yes.
Do you think this is a good tactic?
It's basically their only tactics. They waited much too long to react to rising inflation, saying inflation was only temporary. Then they saw that inflation was not temporary, or at least more sticky than what they saw. And then they started to react, and now they have gone basically in the opposite direction. Now they say inflation is the main problem. We have to get inflation down, and the only way they can do it is basically by increasing interest rates, slowing down demand, maybe increasing the risk of a recession, and that's basically their way of fighting inflation. But the problem is that some of the factors behind inflation come more from the supply side than from the demand side, and therefore the central banks, it's basically they can't fix these problems coming from the supply side.
In the US, the economic situation isn't very favorable either, and real GDP is declining. While consumption seems to be following the same path, the government support measures taken during the COVID crisis have now ended. What impact could a recession in the US have on a global economy?
Yes, US still is the main growth engine for the world economy, so a sharp slowdown in economic growth in the US would have a major negative effect on the rest of the world. So more so since the second growth engine, China, is also not looking too good.
In Europe, the issue of the impact of an energy from the war in Ukraine is at the heart of everyone's concerns, and the 27 are not necessarily in agreement on which tactics to adopt to protect their businesses and citizens right now. Germany has put some 200 billion on the table to support its economy. Is this a good move from an EU perspective?
It's always a little bit in moments like this, you see the problems with the construction of the single currency. When everything goes well, then obviously there's not a problem. But when things go less well, then you see that there are major problems behind the construction of the single currency, and then you find yourself sometimes in a situation where every country first of all looks after itself. So and problem now, I think it makes a lot of sense to protect to a certain degree the consumers and businesses against the increasing energy prices, but the problem is that public debt is already extremely high, and so if you try to support consumers and businesses, that also costs money, and so you have these problems that some countries are better able to afford this increased spending than others. That's why other countries have a little bit criticized Germany about its own stimulus program.
Is Europe politically and economically equipped to provide a good, clear and adequate response to the energy challenge right now?
That's a very difficult question to answer to. I think the main problem is that this energy crisis is coming after the pandemic, after the financial crisis, etc. And all these crises that we had have only added to the debt levels in all the economies. And so from that point of view, I would rather say that we're not too well prepared to fight this new crisis, because again, there comes a moment when these very high debt levels will no longer be accepted, or will really have negative consequences. Until now, and as long as interest rates were so low, the cost of that debt was not very high. But now we are in a situation where you have high debt levels, interest rates are rising, so the cost of servicing that debt is rising, and that sooner or later becomes a major problem.
Let's move to the UK. Britain is no longer part of the European Union, but it doesn't prevent us from keeping a close eye on what's happening across the channel. Especially right now in the UK, serious political and indirectly financial crises are a concern. For example, with the new Prime Minister, Rishi Sunak.
Yeah, but the UK, to a certain degree, what happens in the UK illustrates a little bit what I was just saying, the risks that sooner or later the authorities will lose their credibility. In this case, in the UK, it was more the political authorities, but it might also be a time when central banks, so the monetary authorities, are losing their credibility. And that's, I think, a major risk longer term for the economies and for the financial markets.
Let's have a look to Asia. The Chinese economy is also slowing down while the property market is under pressure. What would be the danger if the Chinese economy suffered a more pronounced collapse?
Yeah, as I was saying before, the Chinese economy is the second growth engine for the world economy. So from that point of view, a sharp slowdown in Chinese growth is not very good news for the rest of the world. And as you were saying, you have these very big problems in the property sector. You have the COVID policy of the Chinese authorities, which is also not helpful to economic growth. And then basically you also have the reality that Chinese economy nowadays is very big. So it's not realistic to expect the Chinese economy to continue to grow at 5, 6 or 7% per year. I think nowadays 3% would already be quite a good number for Chinese growth.
Unsurprisingly, the financial markets have trended downward since the summer. Is this a situation likely to continue?
Yeah, I would at least say that the environment for the general environment for the financial markets is remains unfavorable. So, in the sense that interest rates, at least short-term interest rates, continue to go up. Normally, financial markets prefer lower interest rates and not higher interest rates. And for the equity markets, if we are entering a major economic slowdown, that will obviously weigh on profits of companies, and that's not very helpful for equity prices. So right now, at least, the environment is not very favorable.
Logical consequence: if equity markets are low, is this a good time to go in?
Yeah, but I wouldn't say that equity markets are low. So when you look at the correction we had this year and you put it into context and you simply compare what the markets are doing this year with their movement of the last 5 years, they still remain quite high. And what's more, valuations remain relatively high. So from that point of view, I don't necessarily think that it's a buying opportunity. Basically, equity markets, there are two factors which are important, interest rates and company earnings, and both are not going in the right direction.
Meanwhile, bond yields are rising pretty clear. Is this type of investment back into favor?
Yeah, first of all, one has to say that bond markets and bond prices have gone down as much as equity prices this year. So the increase in interest rates has clearly done a lot of damage within the bond markets, and bonds are supposed to be the risk-free assets, or at least assets with little risk. But this year, obviously, they have been very their performance has been very negative. Now with long-term bond yields having risen again, at least in certain areas, in certain regions, bonds start to look more attractive again.
Should we be looking closer at other financial markets like Asia and Japan in particular, which is not performing as poorly as others?
Yeah, Japan, we've often said Japan is an interesting market. Japan is also amongst the major equity markets, the one who's performing best this year, at least in local currency. Obviously, the yen is very weak, but in local currency, it has been one of the best performers. And Japan is an interesting market because you have a structural increase in the profitability of the companies, and the valuations are quite low. So from that point of view, you have an interesting combination.
As an investor, Guy, I am torn between so many uncertain and not necessarily positive variables. What's the best stance to take?
It always comes back to your investment horizon. If you have a short-term investment horizon, one could say that anyway you should never then be in equities. But if you have a short-term investment horizon, as we were saying just now, the environment for financial markets doesn't look too pretty. So, and at the same time, you get at least you again get some interest on your savings account. So from that point of view, remaining a little bit more in cash might be a good choice. Longer term, I still think that you should clearly favor what I would call hard assets, real assets, compared to monetary assets, and that basically means equities. But you have to be very selective and try to find equities of very good quality companies.
Finally, Guy, and like always, what about gold? Could this safe haven once again be a winner?
Yeah, gold has had an interesting performance this year. It has obviously declined a little bit, but you could say its decline is moderate when one takes into consideration the fact that interest rates have gone up quite a bit, and normally gold is negatively correlated to interest rates. So from that point of view, its performance this year, and the more so in euros, has not been too bad. But I think the major positive point for gold would be if central banks stop their monetary tightening too soon, because there might be some decline in inflation, and they could say, okay, we've won our fight against inflation. They might stop their monetary tightening, and without inflation being really structurally on a lower trend, and that then would be a positive environment for gold, but that's not happening yet.
Thank you very much, Guy Wagner. We keep in touch. Looking forward to see you next time. Bye-bye.
Thank you.